Well, one of the topics that came up today was the idea of equity indexed annuities, and I've talked about that several times on the show, but I thought I would give you some insights that I shared on last week's radio show and talk a little bit about it, maybe give a little bit of a visual to it as well. Equity indexed annuities, an insurance company product. You hear a lot of times people do workshops, and what they'll do is have dinner and they'll talk about how you can get returns of the market or get market near returns without any downside risk. There's no risk of losing any money. Now, number one, that's misleading, because if I put money in, the insurance company pays a commission to the advisor. They're going to get their money back. How are they going to do that? With a back-end surrender penalty. So I can lose money if I need to get my money back out, number one. Now, another thing that happens is this. We have two different ways that we limit returns on these products. Number one, they're supposed to be indexed to a certain area of the market, like the S&P 500. If the market goes up, you're supposed to be able to participate in the market upturn. Now, let's just talk a little bit about how market pricing works. Let's say if the S&P 500 is sitting at 1,000, one way that the market goes up and delivers return is that the stocks go up in value. Now, not to get into the complexities of the pricing and how it all works, that's more of a radio topic, but if the S&P 500 goes up to 1,200, that's a 20% rate of return. That means that the stocks in that went up 20%. In the cap-weighted index, they went up 20% in value. Now, it doesn't include the dividends. Now, dividends are another component of return. You get returns from capital gains, but you also get returns from dividends. We're going to come back to that in just a second. Now, the indexed annuity says we're going to give you these returns and let you participate in the growth of the stock market. Now, two ways that they limit those returns. Three, actually. The first way that they limit returns is they might have what's called a participation rate. In other words, if the market goes up 20% like that, they may only let you participate up to, let's say, 60%. So if it goes up 20%, you get 60% of that, or 12% of that gain. Number one, that's one way that they actually limit those returns. Another way they can do it is they can do a cap rate. Maybe they give you up to 3% of the market gain per month. And a lot of people look at that and go, well, 3% per month, there's 12 months here. I could get a 36% rate of return. Problem is, that's not the way the stock market goes up. It may go up 10% one month and doesn't do anything for the next several months, and then it may go down 10%. A lot of times these products, what they'll do is they'll say, we'll give you 100% of the market return. They may have 100% participation, up to 3% per month. Now what happens, you get that 10% return in that 1 month, you get 3 of it. So the market goes up 10%, you get 3 of it, and then if it goes down 10%, you get to participate in all of that all of that downturn. You get all of that downturn. Kind of a problem if you think about it, because you don't get to participate sometimes in all of the upturn, and then you get to participate in all the downturn. Now they tell you you won't lose money though, so it won't go below zero. You won't go below zero in your return. So that's one of the ways that they limit returns. Another way they limit returns is in the dividends. Now, the dividends are a big component of returns historically. If I look at the S&P 500 and I go and look at the returns of the S&P 500 from 1950 until today, you'll actually see that the returns from 1950 until today with dividends is about 11.04%. So a dollar would have grown to $536. But let's say that I just decided to remove the dividends. And if you look at these equity indexed annuities, they remove the dividends from the return. You'll see it in the fine print. Haven't seen one yet that doesn't do that. And they'll say, you get the return, you get to participate in the growth of the market, but you don't get the dividends. If I remove dividends from the returns from 1950 until today, guess what it grows to? Instead of a dollar to $536, it's $66.92. So basically what we get with these products is basically bond market returns, but with a lot of commission, a big fat commission going to the advisor, and that's why they recommend these things so strongly. If you put $100,000 in, you might get an advisor who gets paid $7,000, $8,000 in commissions for recommending that product. It's a pretty good payday, and it gives them a lot of incentive to tell you things that may not necessarily be true. You can actually see a lot of warnings about these products on the internet. If you care to look at it, go to Google, put equity indexed annuity, and maybe put the word warning, and you'll see a lot more than you bargained for out there on the internet about these investment products. So hope that helps anybody that was thinking about doing this. Maybe gives you some pause to think about it twice. We'll catch you next time.